Welcome to Life Insurance Awareness Month, and today is the first of 5 videos to talk about different types of life insurance. First up is group term. Group term is the type of life insurance where people often say, I got insurance from work already, and have the misconception that they are fully covered for life. Within this category, there are actually two main types: employer-sponsored, where they will pay for the coverage. The other type is called the cafeteria type, where the employer will get this group term for the employees to purchase. So the pros, they are very cheap. One time your salary is free. Additional multiple will just be for a few dollars. The other advantage is for older and less healthy individuals. They can get coverage because it's not individually underwritten. However, the downside of the group terms is very temporary. You only have it as long as you have a job. So does your family deserve no financial protection from you when you are out of that job? The other disadvantage is the fact that it actually does not count as an insurance requirement. For example, parents actually do need coverage to buy insurance for their kids, but this coverage, the group term, does not count as parents' coverage. Lastly, is very generic and one size fits all, and we know everyone's need is unique. So a more customized approach should be needed. All in all, having group term through employer should only be counted as a nice to have, a bonus if you will. And that's it for today. Tomorrow we'll go over another type of insurance, so we'll see you then. Bye. Hello everyone, it's second day of Life Insurance Awareness Month 5 and 5 videos. Today's topic is term insurance. Term insurance is the type of life insurance that lasts for a certain period of time, generally 5 to 30 years. This is purely indemnity, meaning it only pays you if you pass away before the end of the term. So essentially, you're betting against yourself. The pros of term insurance is economical. Is where the TV or radio commercials with advertising for great quotes for a lot of coverage. However, I would not label it as cheap because it is not. It is flexible and straightforward. If you need a 5-year term for your outstanding mortgage, you can just get a 5-year term. If you need to be covered for your newborn child, you can get a 20-year term. Cons of term life is when the term ends, you need to buy another policy or use a renewal schedule of your existing policy, but the cost after your term expires exponentially goes up. Renting. Basically, when the term finishes and you are alive and well, nobody gets anything. That's why I said it is not cheap, because only about 2% of the all-term policy actually pays out, meaning 98% chances that money is going down the drain. Last point, some policies are actually convertible, meaning they can go from term to permanent. When you have options like that, meaning it will cost you. Therefore, instead of labeling it as a pro or con, I would just say it depends. Term is a useful product for families living paycheck to paycheck because of their relatively large expenses. It provides protection for a short period of time, yet is meant to be temporary. Who is to say your life is not worth any money after the term expires? Your life is definitely worth a lot, so don't sell yourself short. That's it for today, and let's continue tomorrow. Happy Wednesday, third of my 5 and 5 video, and today's topic is whole life. Whole life is one of the permanent type of insurance. And by permanent, we mean it covers the entire duration of your life. The pros of whole life are guarantees. When a whole life policy is approved, policy premium is set for life, meaning the company cannot increase your premium as you age, as they bear the interest rate risk. Another advantage is cash value and tax-free access. Not all of your premium are paying for cost of insurance, unlike term. So some of that money actually pay into a piggy bank called policy value or cash value. Since this cash value is yours, you may actually access them in the future. Cons of whole lives are, well, you pay your whole life. As much as low premium are guaranteed, a policyholder will have to keep paying into it to keep the policy alive. Crediting interest is often fixed, and it can be quite low. And this is the interest they pay you for keeping your money in your piggy bank. On the other hand, the loan interest rate can be quite high. So as much as you can access the money in your cash value, you're effectively borrowing from yourself, and that interest is quite high, meaning that you should only access this money when you absolutely need. Whole life insurance has been around for so long it's like a rotary phone. It was good when it first came out and serves its need. But who doesn't use a smartphone nowadays? Tomorrow I'm going to talk about an upgrade to your life insurance policy, just like upgrading your rotary phone to a smartphone. So talk to you soon. Fourth day of my life insurance awareness month 5 in 5 video, and today's topic is Index Universal Life IUL with my little helper today. IUL is a special class within the universal family of life insurance, which is the other type of permanent insurance. Index means how the crediting of your policy value works. Namely, it mirrors the return of the chosen index in the marketplace, most likely the S&P 500. The pros of IUL. Universal in IUL means more flexibility in terms of both premium, the input, and the death benefit, the output side of things. Both can be flexible. So additional flexibility in the form of cash value and tax-free access. Just like whole life, some of the premium dollars are paid into the piggy bank called a policy value or cash value. The good thing is you can access this money for whatever reason and whenever you want. So that makes it an ideal saving vehicle for young children in what we call a $1 million baby program. Indexing, this is a huge advantage that IUL has over whole life, where they would have the crediting to be a fixed percentage. The crediting with IUL is relative to the chosen index. More importantly, there are downside protection, meaning the return can never be negative. So upside potential with downside protection. What's not to like about that? Loan interest rate is low. When you do need to access that cash value of your policy, you don't need to break your piggy bank. The loan interest rate are very low, and with some product, it is even net 0% after 10 years of policy inception. Tax-free and interest-free access to your money. Who doesn't like the sound of that? Additionally, accessing that cash value tax-free does not impact FAFSA or Social Security calculation, as these are not taxable income. The disadvantage of an IUL, well, is capped return with no guarantees. Because there is a guarantee floor to the crediting return, the insurance company also put a cap on the upside. Also, because of the crediting return are not guaranteed, some people may find it a little unpredictable. All in all, this IUL has been around since year 2000, and it is the smartphone of our generation, with additional optional feature like long-term care and concierge service. This IUL should be treated as a foundational piece to every family looking to build on their financial future. Speaking of concierge service, let's wrap up the week with that topic tomorrow, and I'll see you then. Bye bye.